Hong, who's a partner and chief economist at Grow Investment Group. Always really great to have you, particularly at a time like this. I'm just sort of still thinking about the quote that Steve just mentioned, right? May we all eventually be vibrant old people. But, it really does speak to the demographic challenges for policymakers in China.
That's right. But, remember that, some of the spending by the older generation is on behalf of the younger ones, because the younger ones is experiencing this saving. And, the jobless rate amongst the young people is very, very high in China right now. So I think, some of the youngsters, have been spending the pocket money from the older generation who are enjoying retirement benefits. And right now, because the Social Security is still properly funded, so the pension payment to the older generation is actually can ensure a rather comfortable life. And I think that's the reason why Professor Gao is making such an observation, a very interesting observation as well. I think just now Steve mentioned about the consumption coupon, and many of the tier 1 cities, especially in Shanghai and Beijing, handed out, probably hundreds of billions of worth of consumption coupons. But, these are the coupons that you have to spend to get the discount, right? So the coupon usage rate is about 50 to 60%. It's not very high, and it's very different from handing out, cash to the population. So yeah, as the rest of the market, we're still waiting for more specific details from the government.
Yeah, as Steve also points out, fan of welfareism, right? But you say the conventional, policies are not working. Should they be looking at things like just direct payments?
Yeah, I think at this stage, most of us recognize that, the conventional policy doesn't work because the housing bubble bursting is still ongoing, right? So even though we have a reasonably a rebound in October, but we've seen similar rebound after the reopening in early 2023, right? So back then, we actually had 4 months of consecutively increase of housing transaction volume and price increase. And then it's all the way down from there. So I think, right now, no one can conclude that the property market is coming back to life. I think right now, if the property market is not recovering, then the credit growth through the property sector as it used to be cannot be regenerated either. Right? So even if you cut triple R, probably before the year end, we will see another 50 bips triple R cut, and probably next year we're probably going to see 100 basis point interest rate cut. But I think this policy has proven to be sort of futile to lift the Chinese economy, and therefore more unconventional policies needs to be done.
Is that still potentially just a short-term fix, right? Because perhaps longer-term reflation measures might just be difficult if this is a longer-term structural slowdown with a new normal of slower growth in China. To that end, do you still invest around that? Is that still a compelling investment thesis?
Yeah, I think this year, if you look at the asset price performance, right? So the best performing asset class is actually Chinese bonds, right? So it's actually one of the best performing asset class in the world, right? So it's showing you that the disinflation or deflationary pressure is on, right? So the GDP deflator has been in negative territory for more than a year, and I think PPI upstream deflation has been around for more than 2 years, right? So it's showing you the scale, the magnitude of the deflationary pressure on the Chinese economy, right? So at this juncture, because if you want to stimulate Chinese consumption, this year Chinese consumption is probably about 50% of GDP. It's actually less than the historical average. So if you want to stimulate consumption to reach 5% growth target, it's going to be particularly hard unless you come up with something very creative. And on the external environment, you have the trade war ongoing, right? So that is going to exert pressure on Chinese exports growth, which has been a major contributor to Chinese growth in the past couple of years during the housing downturn. So now if the foreign demand for Chinese goods is slowing down as well, then it's going to hurt your export growth and as such GDP growth as well. So I think right now, even though we're seeing some promising signs from the conference, and consumption is indeed, the one of the first priority that the government is trying to address. But more creative policies needs to be seen for the market to have the confidence back.
Sector-wise, what do you like? I know that small cap tech is one element. Why?
I think those are the guys who is more likely than not going to get the government subsidy. And also those are the guys that is less affected by the trade war and also by a weakening Chinese currency. I think the market is looking at a substantially weaker Chinese currency going into the next couple of months. And I think, for the smaller tech firms, for example, the A500 index actually has been performing quite well and has been rather resilient in the recent market volatility. So I think these are the firms that is holding promise for the future. Some of them have rather promising technology patents. They're going to get subsidies from and policy support from the government, and also the valuation on these smaller cap names is not too excessive, and it's justified by the growth prospects, and is attracting a lot of funds going into these sectors. So I would say that if the economy is performing 4%-ish growth, then these sectors are probably one of the better exposure that investors could have in the Chinese market.
When it comes to the degree of skepticism in this rally, and in fact since October, right, do you expect that to continue until we get perhaps more details in March?
I think in March we're bound to get more specific details. For example, one shouldn't be surprised to see fiscal deficit level raised to 4% and above. Between 4 to 5%. I think there will be specific guidance on a special purpose treasury bonds issuance and also ultra long dated treasury bonds issuance as well. So all in all, the budget deficit on a broadened sense would be about 10% plus. Right? So it's not a small scale stimulus by any measure. But then having said that, this year we did slightly less than 10% budget deficit. Right? So one shouldn't be too surprised to see that going into next year we should increase the budget deficit level, given what has been said in the Economic Work Conference. So I think come March, normally the Chinese market would be waiting for more details from the twin sessions.
The thing with Chinese equity markets is you never know quite how the retail component is going to react, right? If you had to make a bet, do you think the next 20% for Chinese stocks will be up or down?
Next 20%. That would be like a bear market or bull market. I think the Chinese market has been locked in a trading range for decades now, right? So for more than a decade, it's around 3,000, right? So it's just appalling, the performance. And I think reason being the economic growth model is running into obstacles, in a sense that the growth efficiency, the capital usage efficiency is declining, and also the labor productivity growth has been slowing down as well. So I think as a result, the market indices has been stuck in the range for more than a decade. But having said that, though, just now we discussed some of the opportunities within the Chinese market that could give reasonable performance for investors in the Chinese market. I think if I have to say whether it's a bull or bear market, and I think it's going to be still range bound until we find a solution towards future growth.
I had to ask you that question, of course, being the one who has in the past called the rise and the fall of the China equity story before. Hao Hong, always great to chat with you, partner and chief economist at Grow Investment Group.